done land, I've done flips, I've done rental property. And I love the real estate world because it's a solid, tangible asset. But as everyone will see today, when we coordinate the infinite banking plan with real estate, we're able to spin off more income, make the real estate more valuable. It's pretty remarkable. And I'm excited to dive into the details of what we go through today.
Well, I'll just mention, Barry, it's awesome that you're a very involved real estate investor with this strategy yourself, which is awesome to bring that to our visitors.
Yeah, and it's important for people to know that they can coordinate their infinite banking policy with real estate. What I primarily do is use my policy for down payments on real estate. And we're going to get into some numbers today to really see the details and how enhanced it will make the real estate. But I'm glad you mentioned that, because when you're working with an advisor that is doing and has done what you're encouraging other people to do, it just makes things, I think, better off for everyone when you can speak the language and say, I've done this myself, I'm doing this now, let me show you how to do it.
I love it. And you'll be able to demonstrate. The beauty of it is you can demonstrate from personal experience how the numbers work and all that great stuff that I know I'm looking forward to.
Great. And maybe a quick heads up, I share this usually in a webinar, that when people come in, make sure that you're paying attention. The numbers we go through today are pretty powerful. So turn off your cell phones, shut down anything that's going to distract you, get away from Facebook, all those types of things. Put away those distractions so you can really focus on the numbers. Because I believe what you see today, you'll probably have a paradigm shift. You may have some beliefs that aren't necessarily accurate. And after today, you'll see things in a brand new light. So really pay attention to what we go through. And our goal for the webinars, you know, Steve, we want to help people understand how infinite banking coordinates with real estate, number one, but also to learn about a better system for real estate investors. And one of the primary reasons for this is a lot of real estate investors sit on cash and it's sitting in a bank account, earning, we'll just say 0% for easy math. But also we want to show them how to create more wealth along the way and use accumulated money tax-free or tax advantage in these infinite banking plans.
Awesome. Well, just for you guys watching too, we've written quite a few articles on this. This is huge for real estate investors, so those resources are going to be available to you. But I'm interested in seeing how Barry paints the picture here for you guys.
Cool. So let's dive in. How to boost your real estate income using infinite banking. And we're going to start off with this question. And the question is, can your dollars do more than one thing at the same time? That's the question that we want to be thinking about throughout the webinar. Can your dollars do more than one thing at the same time? And I've pulled up this picture of Gladsen Peter. He can play over 40 instruments and can play 22 of those instruments, Steve, at the same time. The one-man marching band. And what's cool is you see him playing guitar, but look at the rope attached to his wrist and the rope attached to the headstock of the guitar. He's able to kick the bass drum, and he's got a piano there and harmonica. So he's doing all this at the exact same time. And we were talking before the webinar, we both play guitar. And I've been a musician almost 40 years of my life. So this resonates with me. I love music. But here's a guy, Gladsen Peter, that can play 22 instruments at the same time. So we go back to that question. Can your dollars do more than one thing at the same time? Kind of like we're seeing Gladsen here play 22 instruments at the same time.
Yep, it's a great illustration.
Yeah. I'm going to pull up a whiteboard and we're going to talk about compounding, the compounding effect of an infinite banking policy.
True compounding, right, Barry?
True compounding. There's a myth behind some compounding. You'll talk to financial advisors or others out there that are putting people into market-based investments, and they'll talk about compound interest. If you're in a volatile system that can go up and down, there isn't true compounding, because one year you might lose dividends that you've reinvested, or your gains could be lost if there's volatility. The only way to really get true compound growth is if you're in a guaranteed investment where you know for sure every single year that investment will grow. That's where true compounding comes into play. So what we're going to be looking at in the illustration is we're going to see a point where the cash value has grown to $172,000. And we're going to be taking a loan on that $172,000 for $150,000. And what happens when we talk about compounding, when you take a policy loan from a mutual life insurance company, they don't physically remove the money from the cash value. They put a lien against it. So what that means, Steve, is your full $150,000 is still earning interest. It's still growing and it's still working for you. That's the point I want to make here.
Yep, that's obviously available with every whole life policy, mutual whole life policy. And that's a very common thing and easy to get the cash out, easy loan process and all that stuff too, right, Barry?
Right. It's 3 to 7 days for them to give you a loan. There's no application, there's no credit check, and they don't question you, what do you need the money for? If we compared this to either a stock market account, a savings account, or even a CD, when you take money out of those other types of investments, what happens is you end up breaking the growth curve, and then you have to start over again. With a life insurance policy, ultimately there's no lost opportunity cost because your full cash value is still working for you. It's still compounding and it's still earning dividends. What this does is it gives us what's called the velocity of money, that your dollars are able to do more than one thing at the same time, just like the musician we saw a few minutes ago.
Yeah, so Barry, this is an awesome concept, the velocity of money, and we could do probably an entire discussion together on this. But in my experience, what got me intrigued about it was just that the banks utilize this concept. They never have their money sitting. They're always putting it to use. So they get money and they lend it out at in multiples, and you can maybe talk more about that. That they always keep their money moving, and ironically, then they tend to counsel people to keep their money parked. So we don't want to do that. We want to keep the money moving, and I think that's my understanding of this concept. So
yeah, exactly. And there's some benefits besides what I just shared. When you look at infinite banking and the velocity of money, you're not only getting the guaranteed growth, but that borrowed money, it's still working for you. And the phrase that we use is there's no lost opportunity cost. And that's really important. If you can capture all the opportunity and not have a cost to the opportunity, you now have an asset that is an and asset, A&D, meaning you can take the policy loan, invest in real estate, own the real estate, and still have your cash value working for you. You can take the policy loan, invest into your business. Your business is growing and the cash value is still growing. So it's working for you even though you borrow it. But you're able to leverage your dollars. Number 4 here is tax advantaged or tax-free use of money. If it's done correctly, if we don't violate what's called the MEC limit, and you keep the policy in force until you pass away, most of the time, it is completely tax-free. It can also be used as collateral. There's a death benefit there to protect your family, and the list goes on. So I've just highlighted a few, but look at all these things that one infinite banking policy is doing for you at the same time.
Right. So Barry, do the banks do this? Are we kind of thinking like the banks when we do this?
Thinking like the bank. And you said it. They want to pull in deposits and then use that money in multiple ways. And that's what they're doing. So if we can take the banking function back in our own life, act like a bank, we're going to grow interest like a bank and so many other uses.
So for real estate people, that's a dream come true, right? Because you're really acting, you're able to act like the banker for your own investments.
Yeah. And I don't know the last time you took a loan, but the last time I took a loan from a bank, I had to sign about an inch thick worth of paperwork.
Mm.
It took 30 to 45 days for an approval. You know what I mean? It's like
Oh, yeah.
so much they ask for. When you control the bank function, you have access to this liquid cash within 3 to 7 business days. And there is no application, no credit check. It just makes your life as a real estate investor that much easier, and you are in control.
Yeah, and it's amazing. I know just in my talking with people, I use real estate and financing with the equity in real estate to just illustrate the idea of what you're talking about, taking cash out of a policy. But the difference is that you have liquidity within your policy where you really don't have much liquidity with real estate, because it takes so long, you have to apply, like you said. And you also get this guaranteed growth, which you really don't have with real estate. I mean, you might have an idea based on the market, but you certainly don't have the guarantees.
Right. The real estate can go up and down in value. And what happens if there's a situation like we experienced in 2008, where borrowing from banks becomes very difficult? You might have a lot of equity wrapped up in your real estate properties, but if the banks aren't willing to give it to you, what does the equity do for you?
Yep. Awesome.
Now, there's several other webinars that we have on the website that talk about infinite banking. So I'm not going to go into this with a lot of detail, but this will be a 30,000 foot view. What is infinite banking? It is a uniquely designed, properly structured whole life cash value insurance policy. It must be with a participating dividend paying mutual life insurance company. And it does have a few different names, Steve. You know some of these, and I'm sure people watching the webinar have heard some of these. Bank on Yourself, the 770 account or 702J account, cash flow banking, cash flow insurance, family banking, and then also COLI and BOLI. Those are acronyms for corporate-owned life insurance or bank-owned life insurance. And there are other names besides this, but in a nutshell, it's all infinite banking. However, it doesn't mean that all of these different names or types of infinite banking, that it's being done right. And so I just want to emphasize whole life, dividend paying mutual company, and we use a properly structured policy with a paid up additions rider. So we're very aggressive on cash value growth, and we're minimizing death benefits. And we'll see some of that in the illustrations I share.
Right. And for anybody watching, to get background on paid up additions or anything that Barry mentions that you're not sure what he means, or you want more information, there's always the website. You can search on the blog site for those kind of terms, and lots of information will pop up on that. And but the other thing is COLI and BOLI. I just wanted to point out that's social proof or whatever, but it's a fact that the big corporations and banks own huge portfolios of whole life insurance and used for similar purposes, correct, Barry?
Yeah, and we've got some of the names up here on the screen. They want the same benefits, Nike and McDonald's and even the banks. They want the guarantees. They want that tier one safe capital. No matter what the market's doing or the economy, these cash value policies, they grow year in and year out. And corporations, individuals, banks, they like that, they want that, and there's a lot of social proof out there. So I'm glad that you mentioned that, and we can see we're all familiar with these names on the screen. It's really important to know, because I hear often from my clients, Barry, why isn't this more popular? Why aren't more people doing this? Well, I often say there's more than you think, but it isn't talked about a whole lot, especially by the banks. They would prefer their investors purchasing or investing in IRAs and mutual funds because they earn more fees off of those types of investments than they would a whole life policy. But it is more popular than people think. You just have to look for it and know where to look. In summary, an infinite banking policy is an asset that never stops growing. And I want to focus on that word asset. When we focus on the word asset, don't look at this like a cost. yes, there's a premium payment, and you can determine how much you want to put in for a premium payment, but it really is an asset, which reminds me of Robert Kiyosaki's book, Rich Dad, Poor Dad. He talks about investing in assets.
So Barry, before you jump in there, let me stop you just for a second. You really got my attention with that last slide and talking about how this is an asset that never stops growing. And as we record this, we are sorting through the fallout of recent major market fluctuations, correct? So I was just going to pick your brain for a second. How much was lost in the last, due to some of the things that are happening right now, and wondering if, that's a big difference, right? An asset that keeps growing versus an asset that fluctuates.
Yeah. And we don't know ultimately what's going to happen in the market day by day, but currently it's down about 25%. And I've personally had conversations with my clients who have old market money, or they're putting money in the market, which isn't with me because I don't do those types of investments that are volatile. And I've had clients tell me, hey, Barry, I've lost 100 grand. I had someone tell me 2 days ago they had lost 400 grand. So it's real. And yes, it's just a paper loss right now. But one of the people said that they were ready to retire this year. They can't, because they don't want to start taking money out of a down portfolio. That's going to add salt to the wound. They're already hurting because they've lost 25% of the portfolio. But it's unfortunate that we see the market volatility. So to your point, to reiterate, an asset that never stops growing, that's a true fact. Clients today with me that have these infinite banking plans, they're making money right now.
Yep. And you never really worry about it. I can say that from experience with my policies and whatnot. I mean, you know that they're solid, and that's that safe bucket mindset. You really want to have that. You mentioned the other day, Barry, you want to have that in your portfolio. So
that's right. If you want to take risk elsewhere, that's fine. That's a personal decision. But everyone, in my opinion, should have a safe bucket of money. And infinite banking is the best way to go because your dollars are doing more than one thing and you get that velocity of money.
Velocity and guarantees all together. Yeah. And I love Rich Dad. So looking forward to hearing more about that.
He teaches very solid financial principles. Although it's a real estate book, he doesn't talk a whole lot about real estate. He talks about financial principles. And one of those principles is investing in assets. But Robert will tell us time and time again that it's more important to have cash flow. And think about this. When you're listening to the so-called financial gurus out there, they talk a lot about net worth. Even the big companies, the Fidelities, the Charles Schwabs, the Merrill Lynches, Ameriprise, all those. They talk a lot about net worth. But if your net worth doesn't or can't produce cash flow, it's money that you're not able to really capitalize on. And that's one thing I love about real estate is the cash flow aspect of it. And then later in life with the infinite banking, we can take cash flow from it as tax-free income. We might have time to get into that on the webinar, but ultimately cash flow. Cash flow is more important than net worth.
That's huge, and it can be an important part of your retirement plan, is what you're really saying.
Yeah, exactly.
Well, and just to interject, I mean, we see a lot of that on the estate side. We see a lot of asset-heavy estates that aren't very liquid. So life insurance in general has been used for a long time to help provide the liquidity to help cover things, because if you own a business, you own real estate, a lot of times those assets aren't very liquid, like you mentioned earlier.
Yeah. And if it's not liquid and it's tied up, again, what good is that going to do you?
Right. Looks good on the balance sheet. But...
Yeah. All right, Steve, we're going to look at a real illustration. And I've designed this on LeBron James. And I'm using LeBron. One, he's a public figure. A lot of people know who he is. But he's 35. And so we want to look at an illustration based on LeBron at the age of 35 in Preferred Plus Health and what's happening inside the policy. How's the cash value growing? What do his premium contributions look like? And this is a real life infinite banking illustration that I've designed with a top 10 mutual insurance company that pays dividends. They've been in business over 170 years. They've been through world wars, the Great Depression, the crash of '08, and they're thriving today. In this illustration, we're showing LeBron putting in $24,000 a year, which is $2,000 a month. And by the way, for everyone listening, the amount of premium that you decide to put into a policy, that's a personal decision for you. But what's great about these illustrations is they're very linear. So if you want to put $48,000 in, you can double all the cash value numbers. If you want to put $12,000 in, well, you just cut the numbers in half. What's happening on this $24,000 a year premium is it's purchasing a total death benefit of $1.6 million. Now, you heard me say a few minutes earlier, the goal is to maximize cash value and minimize death benefit. Why are we purchasing $1.6 million of death benefit?
Barry, before you go on, that's huge, right? If people are listening and they're not that familiar with this strategy, it turns the whole traditional idea of whole life insurance on its head.
Yes,
correct?
That's correct. Because if this $24,000 were going into a traditional whole life policy like you talked about, it's going to be a much larger death benefit, maybe 2, 3, 4 times that amount. But what's cool is LeBron's only purchasing $558,000 of whole life insurance. The remaining portion is term insurance. I'll get into that a little bit later. But his cost for insurance is only roughly $500,000.
Jerry, this is why you need an expert designing these things.
Yeah, it's important. I'm telling you, I've seen a lot of policies. The individual has no idea it's set up incorrectly. And then I look at it and I point out some of the flaws and problems and show them a correct structure, and they're blown away by the difference.
Well, we're excited about having this opportunity too, because it's been a huge part of the mission, at Insurance and Estates, is to make sure people get this knowledge and get connected with the right person like yourself, Barry. So
good. Thank you.
It's good stuff.
Yep. There's 2 things I'm going to point out before we get into the numbers on the cash value. There's a guaranteed column of cash value, which we see here. And there's also a non-guaranteed. Now, we're going to be looking at the non-guaranteed. And you might ask why. Well, the reason why is because the guaranteed cash value, it doesn't include the dividend ever. So the insurance company is showing what would the cash value grow to based on a guaranteed only. The reason I don't like this column is because you take a company that's been in business over 170 years, they've paid dividends every year, we should be looking at the column of cash that does include the dividend. The reason it's non-guaranteed, Steve, is because the dividend isn't guaranteed, but the guarantee is. It's a guarantee 4%. The dividend is paid in addition to that. We do have to minus out the cost of the insurance for the net return. So the non-guaranteed cash value is more accurate.
Yeah, and Barry, the dividend, just to kind of give people, in case they haven't watched a lot of these yet, these discussions, the dividend's basically in a mutual company, it's a return of premium to people. And so you're sharing in the company's welfare, basically,
That's right.
by taking that. And I think that's an exciting part of it. Also, you've told me, and we talked about it, sometimes when people try to compare using the guarantee only, it's like looking at a policy on its worst day. And oftentimes, if you try to compare something else, a market-based investment, they're kind of averaging it on its best day. Is that correct?
It is correct. You look at the indexes that are out there, like the S&P 500 or the Dow, they're showing the best of the best. And they'll even move companies in and out of those indexes if they're not performing well. So you're right. Market-based investments usually show the best all the time, where here in the guarantees, it is absolute worst. And you notice, even in the guaranteed cash value, you never see 1 year to the next where there are any losses. it never happens.
Yeah, and it's exciting. I mean, just an interjection from personal experience. I mean, usually when you have a policy and you're doing this the right way, you see that kind of play out in your policy as well. So,
And it's fun, isn't it, year to year, knowing that your cash value is growing no matter what's happening in
yeah.
the market or the economy.
Yeah, and the dividends, and if you choose, you have the dividends put back into your cash, basically paid up additions, and yeah, it's a pretty exciting way to go.
So because we're going to focus on the non-guaranteed cash value that does include the dividend, we're going to look at a different page because it's more clear on how the numbers work. And what we're going to show that in the first year when the 24,000 premium goes in, LeBron has available 16,000 of the 24. And in a traditional whole life policy, Steve, that number would be zero. If
Right.
all your money is going to base premium, there's no cash value in year one, and it takes a lot of years for the cash value to grow. But in a properly structured infinite banking plan, you'll see cash value in year one. And this number could fluctuate a little bit depending on age, health rating, and structure. I could make this higher, but then the later cash value may not be as high. So I talk to people often. What are your goals? What are your expectations? What do you want to accomplish? Is it more important for you to have early cash value in, say, 1 to 5 years? Or do you want higher cash value in, say, 10 plus years? All these things come into play based on how I individually design a policy for a person.
So Barry, for a real estate investor, they may want high cash within the first 5 years, and so then you maybe have a slightly different design.
I would. And I've seen it. It's possible to have over 90% of your premium available in first year cash value. So we can get very aggressive. In this instance, you'll see what I've done over time. The premiums that are being paid every year, this 24,000, it isn't an indefinite amount of time. The premium is being paid for 20 years. And then starting in the 21st year, I'm reducing the premium in the illustration down to $10,101. So over the course of a 30-year time frame from ages 35 to 65, LeBron would have put in a total of $581,009. Total cash value at that point is $1.56 million. And remember, that $558,000 death benefit has also grown to $3.3 million. Pretty remarkable when you see the growth here. At this point, we then look at an income play. So yes, the real estate is very important. That's what we're talking about today. But there's an income play here also for cash flow. Tax-free cash flow if it's done correctly. The way that we see the income is here on this page. You notice the income column. It starts at the age of 66. So LeBron is done funding at the age of 65. He's not putting in any more premium, which all these zeros represent, but he's then going to begin to draw out $90,000 a year of income. I ran the income for 5, 10, 15, 25 years through the age of 90. When we do the math, 90,000 times 25, 2.2 million out on a 581,000 total premium that's gone in. And if he passed away at the age of 90, his family potentially would still get 1.2 million in tax-free death benefit. Yeah, very nice, right? What we're going to look at now is that 172,000 number that I drew out on the whiteboard when we were talking about compound interest. $172,000 of cash value. We're going to be taking a $150,000 loan. But I want to compare this to what most real estate investors do. When we look at this illustration, at that point, 7 years in, LeBron would have paid $24,000 for a total of $168,000 cumulative premium outlay. If he did that and put that into a bank account, earning, again, roughly 0% interest, he might have $168,500. But in the policy, it's $172,512. So he has more now than what he's put in total over that time frame.
Awesome. And my mind goes to what else does he have? Because it looks like he's got a lot more than that.
That's right. He also has a $1.6 million death benefit that he's not going to get in a stock or a mutual fund or a savings account.
And then that's permanent too, which is exciting, when you're comparing. I mean, that's what he's working toward, right?
It's permanent death benefit. Truly, if he passed away that year and he had put in $168,000 of cash, his family would get $1.6 million in death benefit. And I'm glad you mentioned this because there's a myth I want to dispel right here. And the myth is, hey, if I get a whole life policy and I die, the life insurance company is going to keep my cash value. Well, in a traditional whole life policy, that might be true. It's not 100% true, but that might be true. In an infinite banking strategy, remember, all he purchased was $558,000 of whole life. This other $1.1 million of term rider, there's no out-of-pocket cost. He didn't pay for it extra per se. He only really paid for $558 of whole life. So if I add up $558 that he did buy, plus the $172 of cash value, that's much less than a $1.6 million death benefit. So in this case, his family is going to get a whole lot more than cash value plus what he paid for.
Powerful.
It is.
Yeah. I was going to mention too, there's another myth that, just backtracking for a second, you talked about in a traditional policy. A lot of times people think that you need to have a policy for 20 years in order to show value, right? But in this strategy, again, that's turned on its head.
Yeah, he's basically breaking even in 6.5 years. But when you look at the cash value increase, it's actually after year 4, in year 4, his policy cash value is growing by more than what he puts in. And then because of the compounding effect, look at these annual increases. On a 24,000 year premium, 33,000 growth, 35,000 growth, 40,000 growth, 45,000 growth. That compounding plays a major role because there's no lost opportunity cost. He's not going to have a down year in his policy. Therefore, the margin of growth is going to increase every year thereafter.
Yeah, and this is exciting too, because when you talk to people that have these policies and have had them and doing them the right way, it's usually the case that it's their favorite asset at some point for this reason.
True. All right, this will be fun. This is what everyone's been waiting for. When we see the numbers in the real estate example, they're mind-boggling. Steve, I still look at these numbers, and I'm the one that built the webinar, and I'm still blown away by the numbers. So do we.
Well, we've been working with Barry for some time, but before we crossed paths, we were always wanting to learn more and kind of uncover how these numbers can be demonstrated. I'll just put it that way because they are dramatic. So I'm excited that you're going to share this, Barry.
Yeah, good. What we're seeing on the screen now, and Steve, can you see that okay? The Insurance and Estates logo and homes here?
Yep, I can see it.
Perfect. So we're going to run an example. We're going to say, what if you are a real estate investor and you want to buy a home using your policy cash value? Now, this is a little bit different to think about, but you're going to understand the entire idea once I get through the numbers. And what we're looking at over here on the left is this is going to be buying the home with cash. And on the right, we're going to compare it to using a policy loan. Most real estate investors aren't going to go out immediately and buy a home with 100% cash. It does happen on occasions. Maybe they're getting a deal and they have to close in 3 days, right? And then they'll turn around and refinance. So it does happen. Usually I recommend for real estate that you use your policy cash value for the down payment portion and then still get 75 or 80% bank financing. But in our illustration today, We're going to buy the house with cash. And the example we're going to use is a $150,000 purchase price for the home. We're going to show that we're going to hold the property for 20 years. And the rent that we're going to get on this rental is going to be $1,500 a month. And to keep things really simple, Steve, we're not going to talk about depreciation. We're not going to take maintenance out and taxes and insurance. We're just going to keep it all very simple. And then as a real estate investor, you can go in and do your own math on those other types of numbers.
Sounds good. Hey, quick question, Barry. So the only thing is when you use cash, of course, there's a cost to that. People don't think about that, right? So you're losing the opportunity cost that you could have got putting the cash somewhere else. Are you going to cover that, or are we kind of just leaving that out of to make it simpler?
We are going to leave it out of the equation here for a minute, but I'm going to pull it back in at the end of this example.
Cool.
Yeah, great point. And it's going to go back to what we talked about earlier when I drew out the compound growth curve of your dollars still working for you and doing multiple things at the same time inside the policy.
Yep.
The first thing we're going to determine is the market value of the house. You hold it for 20 years. What is the value of the home going to be 20 years from now? So we're going to pull up a calculator. We're going to put in the present value of $150,000. And Steve, just for the ease sake of determining the value of the home, let's just use a 3% inflation. That over time, it's going to grow at 3% in value every year, which means after 20 years, the future value is $270,917. So we'll write that down here. 270.
Is that kind of an average, Barry, that you've experienced to be pretty on point, the 3%?
Yeah, I would say it's a fair number because just like the stock market, home values do go up and down.
Yeah.
Depending on the area, you might say, well, I'm going to use 5%. But again, we don't know exactly what the future holds for real estate. Yes, it's a tangible asset, but what's more important as a real estate investor are the rents, because cash flow, like Robert Kiyosaki talked about. So 3%, I would just say for our example today, is a fair number.
All right. So you reminded me of something as you were talking. So when an asset drops in value, you were just telling me this the other day, or we were talking about it, it takes longer for it to recover, right? So this is why maybe a conservative estimate is good, because if an asset loses value, it will take incrementally longer to recover. Is that a good point to make here?
Yeah, it could take longer, or the slope is steeper climbing back up. And the example I used with that client that lost 25% in their market-based portfolio, a lot of people think if I lose 25%, I just have to have a 25% return and get back to even. And that isn't the case. If you have $100,000 and you lose 25% and you're down to $75,000 now in that investment, you have to have about a 35% return to recover from a 25% loss.
Such a powerful concept.
Yeah.
And people have been beating that drum for years. It's really important. You just have to understand the numbers and how they really work.
True. The next component that we want to look at here is cash flow, because we've really hit on this. What's the rent going to produce for us in cash flow? And we're going to simply take a calculator at $1,500 a month times 12, which is $18,000 a year, times 20 years. So our cash flow over that time frame is $360,000. I'm not taking out maintenance. I'm not taking out taxes or insurance. We're using a gross number, but I'm going to be fair about this all the way through. Then we have to minus out the $150,000 that we put down. That's what we paid for the property. So when we add these numbers all together, there's our 360 plus the 270, 917 minus the 150 that we put in. Over the course of 20 years, our $150,000 investment would have returned us 480, 917. Pretty good, right?
Looks like solid and solid return.
Solid real estate investment. Obviously, minus out some of the things I mentioned, but just a solid real estate investment because of cash flow and market appreciation. We bought a home for 150, we sold it 20 years later for 270. But now let's make a comparison. And this is where it gets very fun for me and once again, kind of mind-blowing. When you take a policy loan and coordinate it correctly with your real estate purchases, you'll see very quickly here how much more valuable your real estate becomes. And then I hope every investor says, why haven't I heard of this? Or why am I not doing this? And then take steps to implement it into your own plan. Whether you take a policy loan or buy a property with cash, the market value doesn't change. The home is still going to grow to 270, 917. What does change is the cash flow. And here's why. If you take a policy loan, you're going to have to pay the insurance company back some interest. The companies I use, 5% is the average. What we're going to look at is a loan calculator. And we're going to put the numbers in here. You take a policy loan from your cash value for $150,000. They're going to charge you 5% interest. And Steve, this 5% does go back to the insurance company. Okay, I want to be very clear about that. There are some myths out there on the internet. Unfortunately, people saying when you take a policy loan, you earn all the interest. That isn't true. The insurance company does get 5%. We're going to amortize this over the same 20-year time frame, which would be 240 months. Now, I'll stop here just for a moment. Because you're your own bank, you can determine how you want to pay the loan back. So if you want to do a balloon payment and pay it all off in 3 years, you could. If you want to do a 10-year or 30-year amortization, that's fine too. The insurance company doesn't really care. So you have control here. But to match our 20-year sell time frame of the property, I'm going to use a 20-year amortization.
Yeah, and that's really cool. There's some really neat things about policy loans that I've been able to learn over the years. The flexibility point you mentioned is great. I mean, you don't get that anywhere else, right? And also, my understanding, Barry, when you pay down your policy loan, that money is immediately available again.
That's right. You can keep taking loans for whatever net balance is left.
Which is a huge contrast to if you're using your real estate or a piece of real estate to finance. You're not able to immediately utilize that cash again.
That's right. In this example, the payment going back to the insurance company, which is a principal and interest payment, would be roughly $990. We'll just round that $989.93 up to $990. So let's write that down so we're clear on the payment. We're going to minus $990 from the monthly rent. So now this is our monthly, it's not a mortgage, but for term's sake, we're going to call it the mortgage payment, going back to the insurance company. And what that means is now there's net cash flow of $510 a month. Net. Show net here.
Right. Hey, there was a subtle point in there, Barry, while you're writing. It's not a mortgage. That's huge for real estate investors, isn't it?
It's not a mortgage. It doesn't go on.
It's not a lien.
Yeah, it's not a lien. It isn't showing up anywhere else with your creditors.
Right. Huge.
It is huge. I'm glad you brought that up.
Mm-hmm.
Here's how we do the math. We're going to take the $510 a month and times it by 12. So we see that our net income after we pay back the loan payment to the insurance company Annually would be 6,120. We times that by 20 years for cash flow of 122,400. Now, some people, Steve, they would stop me right here and they would say, Barry, of course it isn't better to take a policy loan. Look at how my cash is depleted. I'm not even getting half the amount in cash flow that I was if I bought the property using cash. We're not done with the equation. But yes, if you stop here and this is all you think about, that would be correct. The problem is we're only painting half the picture right now. The rest of the picture is this, and you brought it up earlier. What is the cash value doing inside of the policy? Because remember, based on the example that I gave with the compounding, that 150, it wasn't physically removed from your cash value. The life insurance company put a lien against your cash value, but your full 150 was still earning interest and dividends.
Right. Versus if they on the paid cash example, Barry, that cash was definitely removed from circulation.
That's right. So what we do in this example, you are being charged 5% interest. The life insurance policy is still earning 5% interest. And with some carriers, it might be 4.35 or 4. But we're going to use 5, so look at it kind of like a wash, but it's even better than a wash. Because if we take the 5% earnings over the same 20-year time frame, the 150 grows to 397. So what we do is we take the 397,995 and we minus the 150 to show that our net cash value growth increased by 247,995. So we did take out the 150 in the form of this number. I did the subtraction between the two. The reason we don't take out an additional 150 is, remember, this payment back to the insurance company, that paid back the 150 loan. So the difference between these two numbers, 150 and 397, is 247,995. Now when we do the math, this is where it gets remarkable. Here's our 247,995. We're going to add the 270,917 back in, plus the cash flow of 122,400. We come out 641,312.
I think I like the one on the right.
Yeah, it's remarkable.
And I do have a question for you that people may have, especially if they've read up on infinite banking or have done their own research. They're going to ask probably about direct or non-direct recognition, or how they know that they're getting 5% or whatever that is. So I assume you might want to speak to that.
Yeah, thanks for asking. And that's why I wanted to mention that the crediting back might be 5%, it might be 4.5%, it might be 4%. Overall, it doesn't make that big of a difference. For example, if I drop it down to 4 and show this calculation, it's still 328, 668. It's not much of a difference. We're still coming out way further ahead as compared to before. But to your point, there are companies that are direct recognition, which means they recognize the loan and therefore they don't credit back the cash value at the total loan rate, which would be 4.5% or 4% instead of 5%.
And in other words, you take a slight reduction on that, basically.
Yeah, maybe there's a 0.5% or 0.65% cost for taking the loan, but the effect of that over time, it really is nominal. And I could get into it more, and there's some articles on the Insurance and Estates website about this.
And
the way the dividends are credited, it really doesn't matter.
Yeah, and I wanted you to comment on it. We've gotten a lot of questions on it. And the more I've learned about it and hearing your perspective as well, it seems like it's a fairly, some may think it's a major issue. It's actually a fairly minor issue in the scope of things.
Very minor. And if there are agents or advisors out there trying to sell a policy and their number one priority is based on direct or non-direct recognition, they're completely missing the mark. And you as a client, if you're feeling that from them, squash it, because it isn't that important. What's more important is cash value growth. And
going with the right company and design and everything that we already talked.
Yeah. And in a non-direct recognition, the company is not recognizing the loan. So if you're being charged 5%, they're crediting back 5%.
Right. Yeah. Right. And yet you can say that maybe the regular rate might be a little lower for that company, right? So you just really, I mean, it's just like you said, it's just finding the best company is really probably the priority. I'm thinking.
Yep, absolutely right. Right company, right design.
Cool. Well, this is looking dramatic so far.
Isn't it nice?
Mm-hmm.
Okay, I'm going to show you one other thing. As if this weren't powerful enough, I just love these numbers, and we can clearly see how good infinite banking is, that we have 641,000 net to us at the end of 20 years versus 480, a very large difference. But think about this. If we take this to the next level, there's a couple ways to do it. Number one, we could pay loans back at a higher interest rate. I'm showing 5%, but you could pay a loan back at a higher rate. Well, why would you do that? So for example, here, 5%, why would you pay back a loan at a higher rate? Well, what if you were going to take a hard money loan? You know, a lot of real estate investors, they'll get a hard money loan, they'll pay 3 points and 12%. If you were going to do that anyway, but you realize, oh, I have cash value, I'll use my policy loan, pay your loan back at 12% or 9 or whatever. Now, if I put that number here in the alternate payback, Steve, I'll use 12. It does raise the payment to $1,600, which you're going to be negative cash flow. So let's do something a little more in line. There we go, 9%. That margin of difference between the 5 and the 9 is an extra $360 a month. Guess who gets that money going back into their policy?
Yeah, the policyholder.
And what's happening now, instead of the hard money lender or another financial institution taking that interest, you as the policyholder are capitalizing on that interest. And if your policy will take it, doesn't allow it all the time because of the MEC rules, but if it will take it or a portion of it, now you're even getting that compounding effect on those dollars. So over time, this 86,000, that's a hard number, but if that's compounding, that could be 95 or 100,000 more in cash value that you got instead of the hard money lender. So that's the first thing I want to bring up.
That's awesome. And because people might be thinking about it, the MEC rules that Barry just mentioned is kind of a factor when you're putting money into whole life policies and how much cash you can put in. So mainly, I think because the IRS doesn't want you to put too much into a policy because it's a good deal. So they created these MEC rules, right? So if people want to look at that, there's articles on the website on that. And it's basically a formula, right, Barry?
It is a formula, yes.
Okay.
The second thing to think about is this $510 a month in net income. A lot of real estate investors spend it. They're using it for income or whatever, lifestyle. But there are other real estate investors that will use that money, they'll save it, and then go out and buy another property. You know, they'll use that money over time for a down payment. Well, where do they put the money, Steve? It is usually going just into a savings account, again, earning 0%.
Yep.
And what I say is, why not put that money back into another policy or your same policy if your same policy will allow it without it mecking? But now what's happening, you're even getting additional compounding on your net monthly income that is going to allow you more opportunity in the future.
So Barry, even if you're up against the limits, sometimes it's wise to get another policy so that you can continue to use the strategy. And wow, when you think about it, where else can you put that money that you get, compounding growth? And we haven't talked that much about tax advantage growth, but that's a factor. And being able to have it in a safe bucket like that.
Yeah, that's the goal.
Hey, Barry, I'm looking at this. Maybe I'm getting ahead of the cart ahead of the horse. There's another factor with this on the cash side, and I did bring it up originally. So we're showing a return on cash on the policy loan side based on the continuing performance of the money, right, in the account. But we certainly we could actually make this picture worse on the cash side if we wanted to try to factor in what they lost by using that cash, I suppose.
Oh, good point. Yeah, that lost opportunity cost.
Because that's at zero. I mean, so you could say that they lost, I suppose if you wanted to be mean about it, you could say they lost 5% or something compounded.
Yeah.
But,
and ultimately what we're seeing in the net result here is $641,312 versus $489.17. And when we look at the true difference between the numbers, we have $160,000 more because they use their infinite banking policy. It's a significant amount of money. And Steve, think about this. What if you're a real estate investor and you're purchasing multiple properties? This is one deal. What if you did 5 deals, 10 deals, 20 deals?
Right.
Now you begin to really see the compounding. As we started the webinar talking about the musician, 22 instruments all at the same time. What if you had 22 rental properties and all of this was happening at the same time?
And this is a cash comparison, Barry. I mean, imagine a lot of people try to use bank financing on these deals. So then the picture looks even more favorable, I'd imagine, or it changes, right? Because you could use bank financing with a policy as well. So
yes,
and probably should if you can, use the cash for the down payment or something.
Yeah, that's right. That will significantly change the numbers. And we want to leverage. That is a big part of real estate, OPM, other people's money. So if we can use bank money for 80% and then 20% down payment, we're taking that from a policy loan. I do have another webinar on that. Talks about increasing your real estate ROR by 3 times because of that down payment portion.
Isn't for the technical people out there, the ROI just explodes on the policy side?
That's right. Yep.
In a good way.
Yeah, exploding in a good way.
Yeah. I mean, it's just so much higher, the rate of return. So.
Well, as we wrap up here, Steve, again, the power of infinite banking for a real estate investor and using this in their own plan makes a significant impact in their portfolio. Is there anything that you want to share as we wrap up the webinar?
I do want to thank everyone for attending. I think what Barry shared is extremely valuable. I guess I would consider this a level 1 real estate investing course as far as this first step for people that are wanting to learn about this. There are a lot of resources on the website, and I know there'll be some more webinars that we'll be doing to maybe talk about some more advanced topics, but this is where you get started, I think. And I've asked most of my questions, I think, just by jumping in, and I appreciate the opportunity to do that, Barry. So.
And for those that do want to take action and move forward, they can click the link below.
Yeah, click the link. If you guys are listening and you're a real estate investor or not, you're thinking of getting into real estate investing, certainly can click the link to schedule a initial conversation over the phone with Barry. I think that's a great first step. I'm always available to talk to people as well, but I think with Barry's expertise, your expertise, Barry, on the IBC, it'd be very valuable for people that want to get started, and certainly welcome people to do that, get firsthand knowledge and get an idea of what kind of policy and options may be available and these kind of things. Definitely welcome that.
Well, Steve, thanks for having me. This has been fun. Hope it's been valuable to everyone checking out the webinar.
Yeah, appreciate it, Barry. Thanks.